Everybody wonders what life looks like for a certain amount saved during retirement. Well, we're going to go ahead and look at a client portfolio here. We're going to look at Mrs. Retired Roger, obviously changed names, and Retired Roger. And Mrs. Retired Roger's 55 years old, Retired Roger's 60, and the state of residence is Florida. Now, I say the state of residence because that's a very important one when it comes to retirement planning because of what?
Taxes.
Yeah, you probably just said it. State income tax. That's something you definitely have to focus on because that does change the plan quite a bit depending on what the state income tax is for the retirement years. All right, so looking here, they have some questions. They have a lot of questions, but let's focus on the top three here that we're talking with them about, and that's how much can they live on in retirement? That's always the primary question that people have. Well, how much can I live on? What does this look like for me? Then they said, well, what should our asset allocation be? What is the breakdown here? Where are we putting our dollars, whether it be in stocks or in bonds? Now, beyond that, we started to talk a bit further. And really the question was, well, what are you comfortable with the markets? Because we have to gauge risk tolerance and understanding that. And one that I found with clients is one thing may be that when they're getting ready to retire and early in retirement, they may feel one way, but they often tend to go a lot more conservative as they go through the retirement years because they start to realize, oh my goodness, now I'm actually drawing money out. I don't want to be as much as growth as I thought that I did. And so that's something that we have to assess. And as time goes on, you'll have to really think through that and figure out what works for you as well as what works for your financial plan. But in their scenario specifically, what they were looking for was growth, but not taking too much risk with their overall portfolio. And then finally, they said, well, do Roth conversions make sense? They've watched a lot of YouTube videos. Everybody talks about Roth conversions. There's a lot of excitement around them and the idea of saving on taxes. So we want to look at that and make sure that we're addressing that as well. So if we're looking at a snapshot here, these are the things that we're going to be going over and looking at within their plan, their probability of success, knowing where they're at, how this looks for them, their net worth, their balance sheet, breaking all of this down, the Monte Carlo, really breaking that down, as well as their allocation is something they mentioned, and their tax allocation, where the dollars are, how this is going to look, whether or not conversions make sense. So let's look at their balance sheet. Let's break this down. And maybe this is something that compares to what you already have, maybe not. So looking at their balance sheet, Retired Roger has $200,000 in a brokerage account. Now, this is non-qualified dollars. Brokerage account is after-tax dollars go in, and then you're going to be taxed on any of the gains. Now, you are going to want to think about what your cost basis is for this. That's very important for planning. Because if he has $200,000 in a $0 cost basis, that means that he's going to be taxed on all $200,000. If it's short-term gains or 12 months or less than 12 months, that's going to be taxed at ordinary income. If it is after 12 months, then that's going to be taxed oftentimes as long-term capital gains at 15%. I say oftentimes because there are some variables that come into play there with how that works, but you do want to make sure that you're calculating in your cost basis. Then Retired Roger has $1 million in his pre-tax 401k, $350,000 in his Roth 401k. Then he also has $120,000 in his Roth IRA. Then Mrs. Retired Roger has $120,000 Roth IRA, $410,000 pre-tax IRA or rollover IRA there as well. Then they have their primary home that is accounted for here of $500,000 is their value. So total net worth, if we break this down, $2.7 million. So they've done a great job for themselves. So we've got a good idea there. And then we're going to be looking at the asset allocation because that's, again, a question that they had asked about as well. So the asset allocation currently, as it sits, 82% stocks, 18% bonds. You can kind of see the breakdown on how all of this is laid out and an estimate there of returns. Again, that's just an estimate based on this breakdown. But let's go back and let's just ask, how much can they spend? Well, after going through the plan and looking at everything, we started to work off of this and figure out what exactly their goals were to really account for how much they wanted and how much they needed. And so when looking at all of that, we had $7,000 in monthly expenses, $8,000 for healthcare annually, and then after Medicare starts, their healthcare is going to adjust and just be based on the national average for somebody that is also on Medicare. Then from there, we looked at their taxes and insurance on their home, which is an ongoing additional expense annually, and that's $6,000 as well. So that was the breakdown there. And looking at that, we plug this in. We have a Monte Carlo analysis that's running 1,000 different scenarios. As you can see, there's that little trajectory on the bottom. If you're around Florida, you probably know it looks like a hurricane trajectory. And so what that's doing is widening out, but it's showing really the top of the stock market or the world's best stock market, the world's worst scenarios, and then finds a median line there out of those 1,000 scenarios. And it says, okay, you know what? you've got a 90% probability of having this amount at the end of life. And that's just over $8 million, nearly $9 million that it's projecting they have. Now, looking at that, I'm going to tell them that there's a good possibility they could spend a lot more money. They would just have to factor in things and maybe make adjustments in the years where the market is down. A real popular term for that is called guardrails that a lot of people are now talking about. Now, we could look at it as guardrails, but really, I like the idea of something else that I'll discuss when it comes to the asset allocation breakdown there. And so let's really talk about that and look at that. And so just what we'd mentioned there, we have the current asset allocations and what we were looking at and how they're positioned. 82% stocks, 18% bonds. Now, the question is where the dollars are going to come from first, and that goes into their tax planning and how that's going to work. But what we really have to think through, instead of just focusing on guardrails and knowing, okay, what times we may have to adjust our living expenses, what we want to look at is, well, how should they be positioned overall? And looking at this scenario, I broke it down and I said, well, you know what? If they take some risk off the table, we can actually consider them going into, let's say, a balanced portfolio. Now their probability of success rises. The reason for that is we're taking some risk off the table, but at the same time, their asset level at the end of life is also going to lessen. As you can see, it's cut basically in half, or just over half, when it comes to the breakdown using that Monte Carlo analysis. Now, what I like to look at is, instead of saying, okay, well, it has to be balanced, or it has to be this way or that way, or doing a guardrails approach. I've talked about it quite a bit, and that's just a simple 2-bucket strategy. Now, sure, your 2 buckets, the conservative bucket is going to have some cash in it and bonds as well, short-term dollars, and then your growth bucket is going to have your stocks. Now, it's not just going to have Tesla or only large cap stocks. Again, it's going to be diversified. But if you simplify this between those 2 buckets, you can start to think through and say, well, if the stocks are continuing to rise, that means that the bonds aren't doing much over here. And generally, when that happens, what you can do is actually pull from the stock side. So you have that bucket that you're pulling from. On the other side, when the stock market is down, as long as you have 3 to 5 years in the conservative bucket at all times, then that means that you're going to start pulling from that to really carry yourself through as the market continues to recover, allowing that growth bucket to come back up. So that's what we're going to be talking about with them, and presenting that as their opportunity when it comes to their total asset allocation. Now we've got to talk about taxes, because they said, well, what about my taxes? Should I do some conversions here? Well, looking at this whole scenario, we can see that they have $200,000 in after-tax dollars, and that's in a brokerage account. We have $1.41 million in tax-deferred dollars. That is a lot of dollars there, because the concern that we're looking at now is you're going to have higher required minimum distributions once they hit the age where they have to start taking money out, whether they want to or not. And then we have tax-free assets of $590,000. Oftentimes, the way this is positioned and the way we structure things when it comes to withdrawals is we're first going to take from our brokerage account, then we'll be taking from our tax deferred account. Then lastly, we're going to let these dollars continue to compound, and the $590,000 will be the last asset that we're going to touch when it comes to withdrawals. So we ran some scenarios behind the scenes to take a look at this, and we have a proposed strategy of getting them completely tax-free. All dollars are tax-free in the Roth, and then you've got the other option here of not having all of them in the Roth. You're going to have tax-free dollars, and you're going to have some tax-deferred, and you're going to have now the taxable account. Looking at the breakdowns and the differences here, we're going to have different withdrawal strategies on what we're doing. But as you can see, trying to get all the dollars into converted dollars or into Roth does not actually make sense, because if we're looking at the end of plan assets, now you're probably looking and you're saying, well, those numbers are different than the Monte Carlo. And they absolutely are, because this is based on a cash flow analysis is what we're looking at here. But you have 12.84 million versus 13.2 million, and that's tax adjusted ending dollars. So in this scenario right here, the conversions could make some sense, but we're not looking to convert all of their dollars over, because it could potentially cost them about $400,000 at the end of the plan. And so we've got to find out what's going to be the best balance for them in that scenario. Now, this may be something that works for you and maybe comparative to your scenario. If not, you want me to possibly look at something more comparative to your scenario, let me know the breakdown in the comments, and I may just make a video for you.